Two of Canada's largest pension funds are quietly testing the market on $1.5 billion in Asian private equity and struggling to find buyers at the right price. Meanwhile, the 30-year US Treasury yield just hit 5.2%, its highest level since 2007. Today we're connecting these two stories and adding a third, $2.4 billion Canadian mining bet in the high Arctic that just got the green light today. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Today is Wednesday, Markets and Investing Day. Three stories that on the surface look separate, but are actually telling the same story about where capital is moving and why. In case you missed it, we've got BNN Bloomberg's trading desk coverage on the pension fund repositioning, bond strategist Nick Picard on what 5.2% yields mean for Canadian portfolios, and a major development out of none of it that landed yesterday and deserves more attention than it's getting. BNN Bloomberg's Morning Markets team covered a significant development in Canadian institutional investing this week. Both the Canadian Pension Plan Investment Board, CPPIB, and La Caisse de dépôt et placement du Québec are independently running processes to sell down their Asian private equity exposure on the secondary market. In CPPIB's case, roughly $1.5 billion in Asia fund stakes. Positions in managers like Hillhouse, Bain Capital, and PAG, mostly vintages from 2014 to 2016. La Caisse has a similar-sized China-focused secondary sale underway. The issue isn't that they want out. Secondary sales are a normal portfolio management tool. The issue is pricing. Supply in the secondary market is outpacing available capital right now, which means buyers have pricing power, and the discounts they're demanding are deeper than what these funds are willing to accept, so the processes are moving slowly. A few things worth noting here. First, CPPIB is not a small fund. It holds $225 billion in private equity alone, more than a quarter of its total assets. A $1.5 billion secondary sale is portfolio trimming, not a strategic exit. Second, this isn't unique to Canada. The secondary market globally is seeing supply overwhelm demand. Hamilton Lane flagged this in a report earlier this month. And third, the specific assets on the block are 10-year-old vintage positions. These funds are tidying up their earliest Asia commitments, not making a statement about China exposure broadly. But there's a macro context that makes this timing interesting. To understand why institutions are rebalancing and why buyers aren't pushing to fill the gap, you need to look at what's happening in the bond market. Bond strategist Nick Picard made a compelling case this week for what he calls a fixed income rebalancing opportunity, and the timing on his argument has gotten sharper overnight. As of yesterday, the 30-year US Treasury yield closed at 5.14%, and this morning it's pushed to 5.2%, an 18-year high. Levels we haven't seen since before the 2008 financial crisis. The 10-year is at 4.65%, a 16-month high. Picard's argument is straightforward. With inflation expectations running around 3%, a 5+% nominal yield on 30-year treasuries means you're getting real yields after inflation that are meaningfully positive for the first time in over a decade. For years, bonds were a parking lot. At these levels, they're an asset class again. His recommendation? Use the current equity rally to rebalance back towards the classic 60-40 allocation, and consider using covered call strategies on bond ETFs to generate additional yield while you wait for the rate environment to settle. He also points to the MOVE index, the bond market's equivalent of the VIX, as the volatility to signal to watch for entry timing. Now, Canadian investors need to think about this through a domestic lens too. The 10-year Government of Canada bond yield has climbed to around 3.74%, a 2-year high, pulled up in part by the surge in US Treasury yields, even as Canada's own inflation picture looks different. Here's the split that matters. Headline Canadian inflation rose to 2.8% in April, driven by energy costs tied to the Middle East conflict. But the Bank of Canada's preferred core measures actually slowed, more than expected, to their lowest level in 5 years. So the bond market is pricing in US-style inflation risk, while the underlying Canadian data urges the BOC hold steady. Governor Macklem has kept rates at 2.25% and is threading the needle, acknowledging the energy shock without treating it as entrenched inflation. For Canadian fixed income investors, that spread between a 3.74% GOC 10-year and a 4.65% US 10-year is actually meaningful. You're getting paid a real yield in Canadian bonds without the same fiscal risk profile that's driving US yields to 18-year highs. The data shows something important when you look at the spread column. The divergence between Canadian and US short-term yields is over 110 basis points. That's the BOC Fed policy gap showing up directly in the market. Canada's 2-year is at 2.83%, while the US 2-year sits at 3.95%. But at the long end, the gap narrows to around 120 basis points on the 30-year. That compression at the long end tells you the market sees Canada and the US as sharing the same long-run inflation and fiscal risks, even if central bank paths diverge in the near term. Picard's bottom line for Canadian investors: positive real yields of this magnitude haven't been available in over a decade. The 60-40 portfolio, which many declared dead during the zero-rate era, is worth revisiting. Use the MOVE index to time entry and consider layering covered call strategies on bond ETFs to generate incremental yield while rates remain elevated. Picard's argument assumes this is a cyclical move. Rates are high, they'll normalize, bonds will be rewarding. But BNN Bloomberg's analysts are making a more structural argument that what we're watching is the end of a 4-decade era in fixed income. BNN Bloomberg's trading desk coverage this week laid out what they see as a fundamental repricing of long-term capital. Their argument, the 30-year bond bull market that ran from the early 1980s through 2022 is over, and investors pricing for a return to that environment are going to be disappointed. They point to 3 structural drivers pushing yields sustainably higher, not just cyclically higher. First, growth and inflation dynamics that are stickier than post-2008. Second, fiscal deterioration in the U.S., where every 25 basis points added to the 30-year bond yield adds roughly $50 billion annually to the federal interest bill. And third, energy price shocks, in this case the Iran war and Hormuz disruption, that keep reigniting the inflation impulse just as central banks try to step back. If you accept that thesis, then we're not going back to 2% yields. Then the investment implications are significant. Real assets, commodities, and inflation-resistant cash flows start to look structurally more attractive relative to long-duration financial stress, which brings us to what happened in Nunavut yesterday. Angelo Eagle announced a positive investment decision by the Hope Bay Gold Project, a $2.4 billion commitment to redevelop one of the largest undeveloped gold deposits in Canada. The numbers from their 2026 economic assessment are worth spelling out. The operation will run at 6,000 tons per day underground, targeting annual production of between 400,000 and 435,000 ounces over an initial 11-year mine life. Cash costs are projected around $958 US per ounce, below Angeco's current company-wide cost profile. At current gold prices, that's a project with serious economics, and Angeco is flagging a roughly 26% after-tax internal rate of return. The economics here are worth putting in context against Angeco's broader portfolio. Hope Bay comes in below the company's current average cash cost. That's not typical for a greenfield development at this scale. The timeline runs from capital deployment starting in the second half of this year through to first production expected around 2030, with steady-state output of 435,000 ounces annually projected from 2032 to 2038. Over an 11-year mine life, that's approximately 4.5 million ounces total, a material addition to Angeco's production base. For Canada specifically, the project is expected to generate approximately $2.6 billion annually in exports and create more than 2,000 direct and indirect jobs. Angeco CEO Amar Aljundi put it plainly, this is a multi-decade commitment to Nunavut. 2 other details that usually don't make it into the financial coverage. First, the federal government committed $25 million in funding for the Hope Bay Wind Project, which will be owned and operated by Kitikmeot Tulik Limited Partnership, an Inuit-owned entity. The wind project adds 4 megawatts of wind generation and 4 megawatts of battery storage to the site, directly reducing diesel consumption in a region that currently runs entirely on diesel fuel. This is an Indigenous-owned energy company selling power to a major mining operation, a model worth watching. Second, Angeco Eagle signed a cooperation agreement with the Department of National Defense on Arctic infrastructure knowledge sharing, a sign that the federal government sees Hope Bay as part of Canada's broader Arctic sovereignty strategy, not just an economic development story. 3 stories, 1 through line. Canadian institutional capital is repositioning, selling down older Asian private equity exposure in a market where buyers have pricing power. The reason buyers have pricing power is the same reason Picard is recommending fixed income. At 5.2%, the 30-year US Treasury is genuinely competing with private assets for capital allocation for the first time in 15 years. And if BNN Bloomberg's structural thesis is right, that yields stay higher for longer, that inflation volatility is the new normal, then the Angeco Eagle story is the logical conclusion. Hard assets, domestic production, inflation-resistant cash flows, and a project anchored to a commodity that has historically performed well in exactly this kind of environment. The tension worth tracking: Picard says buy bonds here. This is a rebalancing opportunity. BNN Bloomberg's desk says bonds are structurally repriced. The old playbook doesn't work. Both can be right in different time horizons. Picard may be right about the next 18 months. The structural bears may be right about the next decade. The 5.2% 30-year yield is the number that determines which argument you can act on. Well, that's today's Canadian Macro Brief. All credit goes to the creators, BNN Bloomberg's trading desk and Nick Picard. Links to their original coverage are in the description below. If this kind of daily synthesis is useful for staying on top of what matters for Canadian investors, hit subscribe, hit that notification bell so you don't miss our next brief, and hopefully we'll see you tomorrow. I'm Steve. As usual, nothing here is financial advice. Everybody's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.